Risk management strategies. In earlier chapters, you focused on getting a transaction to closing, contracts, financing, disclosures, settlement statements, and federal regulations like RESPA and TRIDE. Now, we shift to a different but equally important question. How do you protect yourself and your clients when something goes wrong? Real estate is a high stakes, highly emotional business. People are making the largest financial decisions of their lives. Mistakes, misunderstandings, and market shifts can turn into disputes, lawsuits, and grievances. Risk is the chance of loss. It has two key parts: how likely something is to happen and how big the damage will be if it does. A real estate licensee makes complex decisions every day: pricing, advice on offers, disclosures, advertising, negotiation strategies, vendor referrals, and more. Each decision carries risk. Good risk management does not remove all risk, but it reduces the chance that one mistake or one unhappy client will threaten your livelihood. Risk management in real estate is a structured approach to identifying risks before they erupt, deciding which risks you are willing to take, and putting systems in place to reduce, transfer, or fund those risks. Your goal is not to be afraid of practice, but to practice in a way that is thoughtful, documented, ethical, and protected. The 4 core risk management strategies. Avoidance. Avoidance means not engaging in an activity at all so you do not face its risks. If someone never drives, they will never be in a car accident, but they also lose the benefits of driving. In real estate, complete avoidance is usually impossible. If you avoid every activity that might lead to a claim, you would never list a home, never represent buyers, never give advice, never handle escrow funds, and never close a transaction. You would also never earn a commission. Instead, avoidance usually means drawing lines around what you will and will not do. For example, a brokerage might decide not to handle property management because of the extra trust account obligations and tenant issues. An individual agent might decide not to handle commercial leases because they lack the training and feel the risk of making a serious error is too high. A team might refuse to work with a particular investor who keeps asking them to look the other way on disclosures. Avoidance reduces certain risks, but rarely eliminates them. Hiring only experienced agents, for example, may reduce the risk of a rookie mistake, but experienced agents can still violate license law, overlook a defect, or commit fraud. As a broker, you can narrow your risk but never completely remove it. Reduction. Reduction means you still engage in the activity, but you try to lower the odds of a problem or limit the damage if something goes wrong. You cannot avoid fire in a building, but you can install sprinklers and smoke alarms. In doing so, you reduce fire risk, but also create a new risk of water damage. That is how risk management often works. You trade a big, uncontrolled risk for a smaller, controlled one. In real estate, one of the most powerful risk reduction tools is shared decision-making. You provide market data, explain options, and give advice, but the client chooses the price, the offer, or the repair strategy. For example, you may show a buyer comparable sales that support a list price of $500,000. The buyer wants to offer $530,000 to make sure we win. You explain the risks of overpaying, the potential appraisal issues, and the impact on monthly payments. Then you put your advice in writing, and the buyer makes the final decision. If the buyer later regrets paying too much, you can show that you disclosed the risks and the buyer chose to proceed. Reduction also includes consistent systems and documentation, written buyer and listing presentations, standard checklists for disclosures and inspections, email summaries after important conversations, and timely use of written addenda all reduce the chance of miscommunication. The more complex the transaction, the more you rely on systems, not memory. Transference. Transference means shifting part of the risk to someone else by contract or insurance. The classic example is insurance. You pay a premium, and in exchange, the insurer agrees to pay certain losses and defend you if a covered claim is made. You still must act competently and ethically, but you are not left alone to fund a large settlement or legal defense. In the real estate business, transference is commonly achieved through errors and omissions, E&O insurance, and general liability insurance. A firm may carry a policy that covers all licensees, or individual licensees may be responsible for their own policies, depending on state law and brokerage practice. Some states require E&O coverage as a condition of licensure or brokerage operation. Transference can also occur through contract language, such as indemnity clauses or vendor agreements. But you must be careful not to practice law. As a practical rule, licensees do not draft complex legal clauses. They use approved forms and encourage parties to seek legal counsel when additional language is needed. Retention means you knowingly keep the risk and are prepared to pay for it yourself if necessary. This is sometimes called self-insurance. You retain risk when you decide the potential benefit of the activity outweighs the cost of insuring or avoiding it. For example, a very small sole proprietorship might choose a higher deductible on its E&O policy to keep premiums affordable. The firm is retaining the risk of smaller claims and transferring only large ones. Every active real estate licensee retains risk simply by practicing. Even with insurance, there are deductibles, uncovered claims, and reputational damage that no policy can fully erase. Retention is reasonable only when you understand the risk, have made efforts to reduce and transfer what you can, and are prepared financially and emotionally to handle what remains. Risk management in daily practice. Sam is a real estate agent with his own local practice. Just by being open for business, Sam faces risk. A client might trip in his office, a buyer could claim he hid defects, or a deal might fall apart and lead to a commission dispute. Sam knows he cannot eliminate all these possibilities, but he can plan for them. Risk management for Sam means identifying the most likely and most damaging risks, then deciding how to handle them. He knows he needs both insurance and good business habits. Without a plan, one lawsuit could threaten his savings, his reputation, and his license. With a plan, he can practice with confidence, knowing that some risk is inherent but controlled. Insurance as a risk management tool. Basic insurance concepts. Insurance is a contract in which one party, the insurer, agrees to assume some of the financial cost of certain losses in exchange for a premium. The premium is the amount paid for coverage, usually annually. Policies spell out what is covered and what is excluded. Most policies also include a deductible. The deductible is the amount the insured must pay out of pocket on a claim before the insurer's obligation begins. A higher deductible usually means a lower premium, because you are agreeing to retain more of the risk yourself. This is similar to personal auto insurance. You might choose a $500 deductible instead of $250 to reduce your monthly cost. General liability insurance. General liability insurance protects the business against claims involving bodily injury, property damage, and certain personal or advertising injuries. It does not focus on your professional advice. It focuses on general business operations. One afternoon, Joe walks into Sam's real estate office to discuss listing his house. The lobby rug is bunched up, and Joe trips, hitting his head on a desk. He needs stitches and diagnostic tests, and his bills total $25,000. Joe sues Sam's company, claiming negligence in maintaining safe premises. If Sam has a general liability policy with a $1 million limit and a deductible, the insurer will typically handle the defense, attempt to settle, and pay covered judgments up to the policy limit. The policy may cover Joe's medical expenses, Sam's legal fees, court costs, and settlement amounts, subject to policy terms. Without this coverage, Sam might have to pay everything himself, diverting money that could otherwise support his business and family. General liability insurance usually does not cover employee injuries, which are handled by workers' compensation policies. Nor does it cover auto accidents while driving clients around. nor does it protect against professional mistakes, discrimination claims, or intentional misconduct. That is where other coverages come in. Errors and omissions, insurance, A&O. Errors and omissions insurance is designed to protect against claims that arise from professional services. It addresses the unique risks of being a real estate licensee, failing to disclose known information, mishandling paperwork, missing a deadline, providing incorrect information about zoning, or overlooking a material fact that you reasonably should have discovered. Suppose Sam forgets to ensure that a critical addendum is included in a signed purchase contract. As a result, the buyer cannot terminate the contract based on an inspection issue and claims a significant financial loss. If the buyer sues Sam for negligence in handling the transaction, Sam's E&O policy steps in. The insurer defends him, and if necessary, pays settlements or judgments up to the policy limits, after any deductible. E&O policies do not cover everything. They do not cover intentional fraud, criminal acts, discrimination, or bodily injuries. They also do not excuse an agent from the disciplinary authority of the Real Estate Commission. However, they can be the difference between a manageable problem and a financial catastrophe. Business structure and limited liability. Insurance is only half of Sam's plan. The other half is how his business is structured. If Sam operates as a sole proprietor without forming a separate entity, his personal and business assets are legally the same. If he loses a lawsuit and the judgment exceeds his insurance coverage, the plaintiff may be able to reach his personal house, car, and bank accounts. By forming a corporation or limited liability company, LLC, according to state law, Sam can create a legal separation between his personal and business assets. This is called limited liability. Generally, creditors and plaintiffs can reach business assets, but not his personal home or personal savings, as long as Sam respects the formalities of the entity. However, courts can pierce the corporate veil. If Sam uses the business like his personal wallet, commingles funds, or commits intentional misconduct. To maintain the protection, Sam keeps separate bank accounts, signs contracts in the company's name, maintains required records, and treats the entity as a real business, not a shell. Ethical duties as risk management. Many lawsuits and grievances against real estate agents begin with a client who feels misled, uninformed, or ignored. Ethical standards, such as the Code of Ethics and Standards of Practice of the National Association of Realtors, are not just ideals. They are powerful risk management tools. Article 1 requires agents to protect and promote the interests of their clients, placing the client's interests above their own. Doing so reduces the risk of claims that you put your commission ahead of your client's welfare. Articles 2 and 12 emphasize honesty and truthfulness in property descriptions, advertising, and communications. This directly reduces the chance of misrepresentation and fraud claims. Articles 4 and 5 deal with conflicts of interest, such as when an agent, a family member, or an entity they control has an interest in the property. Full disclosure and written consent reduce the risk of a client later claiming you secretly profited at their expense. Articles 6 and 7 address compensation, referral fees, and dual payments. Being transparent about who is paying you and for what reduces the risk of accusations that you received hidden benefits. Article 8 requires proper handling of client funds, including separate trust accounts. Mishandling earnest money or rent is one of the fastest ways to face both civil and disciplinary action. Article 9 requires that agreements be in writing and understandable, and that agents make reasonable efforts to explain terms before signatures. Clear written agreements are among the most effective risk reduction tools in practice. Article 11 reminds agents not to give specialized professional services outside their competence. For example, you can provide a comparative market analysis, but you should not claim to be an appraiser if you are not. If a transaction involves complex tax, legal, or environmental issues, you refer clients to qualified professionals. This limits the risk of being blamed for giving advice you are not trained to provide. In short, living the code of ethics every day is one of the best ways to protect your clients and yourself. Ethics, law, and risk management all point in the same direction: honesty, disclosure, documentation, and client-centered service. Habits that reduce lawsuits and grievances. Despite your best efforts, you may one day face an unhappy client, a complaint, or a demand letter. There are no guarantees, but certain habits dramatically lower the odds and strengthen your position if a dispute occurs. Good communication is the foundation. Clients should never wonder what is happening in their transaction. You keep them informed of all significant developments. Respond promptly and confirm important conversations in writing, often by follow-up email. A client who feels heard and informed is less likely to sue even if something goes wrong. Managing expectations is equally important. You do not promise quick sales at unrealistic prices, nor do you guarantee results beyond your control. Instead, you give realistic advice based on data, explain risks, and give best and worst-case scenarios. When offers come in low or inspections reveal problems, the client is disappointed but not shocked. You let clients make the hard decisions after you have explained the options and risks. Whether to waive an inspection, how much to counter, whether to accept a repair credit instead of a fix, or whether to proceed with a marginal appraisal are ultimately client choices. You document your advice and the client's instructions. You keep thorough records, emails, signed forms, inspection reports, and notes from conversations form the paper trail that can save you in a dispute. When a client chooses a path you recommended against, you politely confirm in writing. As we discussed, my recommendation was X, but you have chosen Y. I will proceed as you instructed. You also choose your clients wisely. If a prospective client is disrespectful, dishonest, or insists that you help them conceal defects, you're seeing serious risk ahead. Walking away from a bad client early is often cheaper than defending a lawsuit later. You avoid fee disputes whenever possible and think carefully before suing a client for a commission, knowing that such actions often trigger counterclaims and grievances. Finally, you carry appropriate insurance coverage and know how to use it. You understand your policy limits and deductibles and how to report a potential claim. That way, if trouble comes, you are not scrambling in panic. You are following a plan. Review summary. In this section, you learn that risk management is not about eliminating every danger. It is about knowing where the dangers lie and putting reasonable, documented protections in place. The 4 classic strategies are avoidance, reduction, transference, and retention. As a licensee, you use all 4, choosing what parts of practice to avoid, where to reduce risks with systems and documentation, what risks to transfer to insurers, and what residual risks to retain as part of doing business. Insurance plays a central role. General liability insurance protects against bodily injury and certain business-related claims, while errors and omissions insurance focuses on professional mistakes and omissions in your real estate services. Business auto, workers' compensation, and appropriate business structures, such as corporations or LLCs, add additional layers of protection. Ethical conduct and clear communication are equally important. The duties found in the Code of Ethics, especially those related to loyalty, honesty, disclosure, competence, and proper handling of funds, function as practical risk controls. Consistent habits of documenting advice, managing expectations, and letting clients make final decisions reduce the likelihood of serious disputes. Ultimately, risk management allows you to keep your focus where it belongs, serving clients well, closing transactions, and building a long-term career, rather than constantly fearing the next complaint or lawsuit. Discussion. How does documenting your advice and the client's decisions help you manage risk in a real estate transaction? Suggested answer. Documentation shows exactly what information you provided and what choices the client made. If a client later claims you failed to warn them about a risk, your emails, notes, and signed forms demonstrate that you did explain it and that the client chose to proceed. This can discourage lawsuits, strengthen your position with your broker and insurer, and provide critical evidence if a claim or grievance arises. Why is carrying both general liability insurance and errors and omissions insurance more effective than relying on just one type of policy? Suggested answer: general liability and E&O cover different categories of risk. General liability focuses on bodily injury, property damage, and some advertising-related claims. E&O focuses on professional mistakes and omissions in your real estate services. Many real estate claims involve both business operations and professional advice. Having both kinds of coverage helps ensure that a wider range of potential problems are insured, so one uncovered incident is less likely to cause a financial crisis. Closing remarks. Risk will always be part of the real estate profession. Markets will shift, buyers and sellers will disagree, and not every transaction will go smoothly. What you can control is how prepared you are when challenges come. By understanding the 4 core strategies of risk management, using insurance and business structures wisely, living your ethical duties, and building strong communication and documentation habits, you transform risk from a constant fear into a manageable part of doing business. This chapter gives you the mindset and tools to protect your clients, your license, and your future.